All right, welcome. If you all want to grab a seat, come on in. And thank you so much for coming today. My name is Casey Schnopp, and I am the chair of the Bench and Bar Committee. I'm also law clerk to Judge Mullins here, and I'm delighted to have you here today and to introduce this wonderful panel. Before we begin, a few housekeeping notes. If you are participating with us on the phone or online, please mute both your phone and your computer. I want to thank, before we begin, Dale Goodman over here at the end of our table for helping plan and coordinate logistics for this event. A big thanks to Craig Raber and our IT department here at the court for all their help in getting this PowerPoint up, the phone connected, and setting up this room even for you here today. And I want to thank you all for coming, and if you wouldn't mind, you should see bright yellow pieces of paper on your table. Those are surveys to be completed on the panel, so just be sure to fill them out, and you can drop them with us or at the table as you leave today. So I would also like one last note before I introduce the panel. If you have questions, we just ask you please hold those to the end. We would love the opportunity for our panelists to answer questions, but they may anticipate some of those that you have, so please just wait and then we'll have those at the end. All right, so sitting to my right is Alyssa Watley. She is an associate at Bomar Law Firm. She specializes in tax relief, audit defense, and bankruptcy. Prior to joining the Bomar Law Firm, she was a courtroom attorney for Berry and Associates. She developed a specialization in tax and bankruptcy law while at Georgia State, where she worked in the Philip C. Cook Low-Income Taxpayer Clinic, and she was awarded the J.D. Moore Tax Clinic Fellowship. During her time at Georgia State, she also interned here with Judge Murphy. And she received her BA from the University of Georgia and currently serves as MacGuide president. So many of you may have received emails from Alyssa. To her right is Vinia Allen, who is an assistant United States attorney in the U.S. Attorney's Office for the Northern District of Georgia. She focuses primarily on representing the United States in bankruptcy cases. Previously, she worked as an attorney with Macy, Walensky, Kessler & Hennings, a bankruptcy boutique firm here in Atlanta. And before that, she clerked for Judge Mullins. She is a graduate of the Catholic University of America, Columbus School of Law, and Florida State University. And finally, we have Whitney Groff, an Assistant Attorney General in the Office of the Georgia Attorney General. She represents state agencies there. Her current practice consists largely of representing the state in bankruptcy cases involving healthcare providers and some charitable trusts, banking and finance, and collection matters. Before joining the Georgia Attorney General, she worked as an attorney at Aldridge Connors, where she represented residential mortgage servicers and investors throughout Georgia and Florida courts. Before that, she worked at McCullough Raymer as a senior staff attorney for Chapter 12 and 13 trustee Nancy Whaley. She is a graduate of Nova Southeastern University in Fort Lauderdale and received her BA from Queens College, where she also captained the women's volleyball team. And with that, I'll pass it on to our incredibly talented and very informative panelists. I hope you enjoy.
Thank you guys for coming. We really appreciate you coming to learn a little bit more about taxes generally. I want to start with just a disclaimer. The opinions that are expressed here are those of the presenters here and don't necessarily reflect official positions of the United States, the state of Georgia, the Department of Justice, so on and so forth. I want to give you just a brief outline of the topics that we're going to try to get through. We have a lot of information, and we think it's fairly helpful, and we want to try to organize it so that you'll be able to take it back and use it in your daily practice. First, we're going to go over tax transcripts, why we need them, types of tax transcripts, why we need them, the types of transcripts, and how you can request a transcript. We're going to discuss things that you should ask your clients before filing. And then we're going to talk about tax issues in bankruptcy, discharge and exceptions to discharge, post-petition taxes, and tax liens. Without further ado, I'm going to turn it over to my able colleague here, Alyssa, to start us off.
Hi, everyone. So the first thing we're going to talk about is tax transcripts, different types. This is important information because you need to know which ones you would like to request and what information is contained on the different types of transcripts. So the first one that we have here is a tax return transcript. What that is a copy of the original return line item. It's not a photocopy of the original filed return. It's really just a line item that will show adjusted gross income, credit, deduction. But it's not going to look like a return. It's literally line item. So it is a little more difficult to follow, but it will have all the information that's obtained on original 1040 form that you're looking for. So it shows the information that would typically be on a return. And so that's helpful if you need to send the trustee a copy of the client's tax return and they can't find a copy. Well, you can provide them a tax return transcript so it has the exact same information. The tax account transcript is the most important, I believe, to determining whether or not a tax is dischargeable. A tax account transcript will have a few basic information and codes that you'll need to know. We're going to look at one later, but generally this will include the taxpayers, the type of tax, the AGI, when the tax return was filed, when the tax was assessed, and generally a record of what's happened with that account. As many of you know, each tax year is treated separately, so that kind of gives you a running record of what happened in that specific year. Were they in collections? Did they file an offer in compromise? Did they file a bankruptcy case? All of that can be readily ascertained from looking at a tax account transcript. A record of account is just those two combined. So if you want to just do that, you can request that and get both of those documents in one. A wage and income transcript. This is helpful when your clients haven't filed returns. I've had clients who haven't filed returns for 20 years. And I was like, well, let's file your returns. I don't have any information. Well, a good place to start would be a wage and income transcript. That shows all the income that was reported to the IRS. That would include W-2s, 1099s, mortgage interest, anything where there's a form being reported to the IRS, it will show up there. The only caveat with that is if your client has their own business, so I was like, well, where's my profit and loss statement? And I was like, well, you know, you create that yourself. That's not reported to the IRS. So that's something that would not be on there. And lastly, a verification non-filing letter is just stating that the return is filed for that year. Next slide.
I have a quick question for you. So on the tax return transcript, how long does that look back? How much time is available in that? What can I find out?
Yes. So a tax return transcript, the one that lists the items that are originally on a 1040, that only goes back 3 years. So if you're looking for a copy of the return further back than 3 years, that will not be available unless you do a special request, which has to do with calling the IRS, and normally will take a few months. A tax account transcript typically only goes back 10 years. So those are your time periods. But in bankruptcy, generally I find we don't, in my practice I have issues way further back than that, but in bankruptcy typically you don't.
Verify that there was
no return received, correct.
And I just want to interject one transcript that's not, there are dozens of transcripts that the IRS can produce. There's one specifically that I found and that I've mentioned to certain attorneys that are helpful. It's called an INST report, that's INST. And this has been helpful to attorneys who have clients who have been in a Chapter 13, they've reached the end of their 13, so they've paid their, their 60 months, and then their client gets notice of deficiency from the IRS, generally for interest on priority taxes. This INST report will let you know how much to the dollar is due. So it's something to keep in mind when you're trying to talk to your clients who are calling you enraged because they've just finished their plan, but they still have a deficiency that they get from the IRS.
Sorry.
we have a lot of information to cover. When we were practicing, we couldn't get through everything, so we're going to try to do it quickly. Okay. So the next important step is, how do you get these transcripts? There are a few ways that you can do it, and most of them are free. The first thing you can do is you can have your client actually visit the IRS webpage that I've listed here, and they can create their own online account and pull their own transcripts. I don't know if you want to trust your clients to do that. Most of the time it's hard to get things from them. So what I would recommend is getting them for your clients. So how you would do that is you need to complete a 2848 power of attorney form. It's free. You can get it off the IRS website. You fill it out. You have your client sign it. I have my clients sign this when they come in to sign up for bankruptcy. It's just one more step, like checking a lien, checking GSE-CCA, looking up car values. Add one more step on there, get a 2848. You're going to fax that 2848 to the number, the CAF unit there. You have to fax it to that number. Everything in the IRS is stovepiped, right? One unit does audits. One unit does collections. This unit only processes power of attorney forms. So send it to them. That's their only job. In 8 to 10 business days, you can either call the priority practitioner hotline, or you can register for e-services, which I've listed the log in there, create an e-services account, and you can check that in 8 to 10 business days and go on and request any transcripts that you've previously submitted a power of attorney form for. Really important, if you are working on a deadline and you need to find out their tax information right away, you can always call CPH and fax the 2848 to them while they're on the phone and say, I've already sent it, but it hasn't processed yet, and I need you to fax, or they can mail it to you, but I recommend them fax the transcripts that you need. Again, all this information is free, so I would just recommend going ahead and getting these services, getting power of attorney forms when your clients come in.
How long does it take if you request it via mail? Do you have any idea?
I would say probably a month. Everything with the IRS is minimum 30 days. If you want to get something by mail, that's why I recommend you have it faxed to you.
These slides will be available on the court's website this afternoon, so you don't have to write down all the phone numbers and websites. Okay, under news and what is it? Under the news section on the right-hand side, if you click on that, you'll be able to pull up a PDF of all the slides. So you don't have to worry that you can't write everything down.
Okay, next we're going to talk about the types of tax, because when you're filling out the 2848, you have to fill out the name of the tax, the form number, and the periods. If you leave off any of that information, your power of attorney form will not be processed. So you can say it's for income tax 2016, and you also say, great, but you forgot to put 1040 on there. So we're going to go over the type of what it's called and the form number so you know what you should be requesting. A majority of our clients only need the income tax. The form number for that is 1040. There are other types of tax: sole proprietors, partnerships, LLCs, and S corps. Those are called pass-through entities. So for tax purposes, the tax from the entity passes through to the individual, and it is taxed on their individual 1040 tax return. So an S corp will have a filing requirement, but it's not going to have a tax due because that tax is passed through to the individual and taxed on their individual return. A C corp is in Form 1120, so that is a separate taxable entity. If they file a tax return, they would have a tax due. They are taxed twice. Employment taxes are very important, especially when it comes to bankruptcy. We're going to talk about trust fund taxes later on, but this is how trust fund taxes are originated. FICA tax is 941, that's Social Security and Medicare. Those are filed quarterly. And then FUTA 940 is federal unemployment tax. That's filed annually, so it's only filed once a year. And the reason this is important is LLCs, S corps, any of these people can have employment taxes, even though they're a pass-through entity and they're taxed on their individual 1040. If they have a business, they could have employment taxes that they're supposed to be paid. So it's important to ask your client, have you ever had a business? Do you run a business? Do you have employees? You know, have you been paying employment taxes? Because if they haven't been paying employment taxes, it's very likely that when we get down to the trust fund tax category, they will probably have that issue, and one of those issues is not dischargeable. So it's really important that you ask these questions. Do you have a business? Do you have employees? have you been current on filing your employment taxes? And if they say no, well, you might want to request a little more information. We'll talk about that later down on this slide. And another important reason is know when they're filed, quarterly or annually. Example is I had another tax attorney refer me a bankruptcy client. She said she had pulled all the transcripts. Of me, a tax attorney, I trusted her. She only pulled one quarter for each year. So I thought that my client's employment taxes were $30,000. So after I saw the case, I got an $80,000 proof of claim because I had all of the quarters. She only pulled the first quarter. There's 4. So don't make that mistake. Don't trust anyone and check all 4 quarters. There's 11 there. Excise tax. That is Form 720. Those are also paid quarterly. And that typically has to do with trucks, fuel. Not really going to come up in bankruptcy case law unless you have a trucker or, I guess, client.
I will note, though, I've seen this past, maybe within the last 6 months, individual debtors who opted not to get health insurance coverage under the AHC, Global Healthcare A. The tax lists on the proof of claim as an excise tax. Just something to be mindful of.
So now you can add that on your 2843, 2840. And then lastly, the most important thing besides income tax, your 1040 that I like to check for, is the withholding trust fund taxes. So those are civil penalties. What you would write on your 2848 is civil penalties, and then trust fund recovery penalties, and then the period. And the reason trust fund taxes are important, how that happens, is you have an employee that's not paying their employment taxes. The IRS will say, we need to find someone who's responsible for paying employment taxes. The 2 elements are willfulness and responsible party. Willfulness is as low as you chose to pay your company's electric bill and you didn't pay your payroll taxes. Willfulness. Done. Responsible party. Any person that's an officer of the corporation, is a bank signer, could be as low as a secretary if they had the power to divert funds from paying payroll taxes. They can go after as many individuals as they need that they can find meet those requirements and assess trust fund recovery penalty, which is a civil penalty that can never be discharged in bankruptcy. So when your client says, I have a business, I have employees, I haven't been paying my trust fund, I haven't been paying my withholding taxes, you best believe the IRS has probably assessed the trust fund recovery penalty against them, and that tax can never be discharged because they were supposed to be holding that money in trust to pay their employment taxes. So that's always a good road to go down once they say they have a business. Okay. Okay, so how to read an IRS tax transcript. What we're looking for is A, the type of tax, those numbers we just went over. That will be at the top of the transcript because you need to know the type of tax to determine whether or not it's dischargeable. You need to know when the return was filed. We're looking for a return that was filed at least 2 years before filing bankruptcy, and whether it was filed by the taxpayer or whether it was filed by the service, which is known as a substitute for return. That means no return was filed by the taxpayer and the IRS took it upon themselves to file a return for your client based on the income and information that was reported to them. We are also going to discuss a case that discusses why substitute returns are non-dischargeable in our district. Tamia will go over that later. So that's something to look for. If you see substitute for return on the transcript, that's going to affect your analysis. And last 2, due date of the return. So the tax return was originally due at least 3 years for filing bankruptcy. So you're looking for when the due date of that return is, and then if they filed an extension. So a taxpayer filing an extension effectively changes their own due date, whether or not they were complied with the extension or not. A lot of my clients filed extensions for 5 years and never filed returns. They effectively changed their due date. So make sure you look out for that. And then lastly, the date of assessment. The IRS has to assess the tax at least 240 days before the debtor files bankruptcy. And if the IRS suspends collection activities during negotiations, it could be extended. So make sure we're going to look at that. But typically the date of filing and the date of assessment is relatively the same date. So the date they receive the return will be earlier, but the date of filing and assessment is typically the same day. So we are going to look at one. I'm going to get up real quick. This is what an account transcript looks like when you For C1, the tax period is going to be up here. We see this is 2012. The form number, we all just learned the form numbers. So 1040 is individual income tax. Right here is typically where you have your taxpayer's name and address. And right here is we're going to see the account balance, the accrued interest, and the accrued penalties. You'll see here when the person filed their return, they only owed $26,000. Interest and penalties will roll into the corpus of the balance, so the balance will be higher typically than a return filed after it's been in collections for a while. This is interest and penalty that hasn't yet accrued or rolled into the corpus. So what are we looking for? We know this form, income tax. We're looking for the due date. So 2012 is typically due on April 15th of 2013. So if we're waiting 3 years, it would be April 15th of 2016. From that point, we meet the 3-year rule. You're good to go. Right? If we're going to file bankruptcy today, it meets the 3-year rule. Next thing we're looking for is filing date. When was this tax return filed? I've labeled it here for you guys. Like I said, filing date and assessment date can often be the same date. See, they received this on August 15th, but it wasn't processed until September 23rd of 2012. So the filing date and assessment date is the same. Again, 240 days. You would be good on that one as well. Another thing to look for that we talked about is due date, right? We just talked about due date, but the extension, this person filed an extension, so the effective due date October 15th would be October 15th of 2016, right? Because they filed an extension, they effectively changed that 3-year rule from the date plus 3 years. And lastly, I just wanted to show you guys there are some tolling issues. So whenever you file, we're going to talk about it in a later slide, but the account transcript shows things that happened in this case. So this person tried to file an offer in compromise, and then it was denied an offer in compromise and filed an offer in compromise again. Each time they try to take these collection relief efforts, they do not work. It can add time to the statute of limitations. We're going to talk about that in a little bit, but this is just an example. Okay, so this is an account transcript that I want to show you where we're looking for a substitute for return. For a lot older years, they used to not, it was kind of hard to tell whether it was a substitute for return or it was a taxpayer's return. So the service is really great about identifying that these days. So I wanted to show you what that looks like. So when you see a transcript, it's an account transcript, and you look at the top, the first thing that's listed there is a substitute for return. That's going to create a huge issue now that we have the justice decision saying that a substitute return is not a return filed. Right? So if you look at the account transcript, this might be a good time to tell your client, it's actually one of my bankruptcy clients, this $50,000 is not going to be dischargeable. So when you get out of bankruptcy, we will deal with that later. So that's a good time to have that conversation. All right. Okay, this is just another account transcript. I wanted to show you a different one. We were talking about civil penalties. Again, this is where you have a business client that wasn't paying employment taxes and could be held personally liable for the employee's portion of those taxes. This would show up on a civil penalty account transcript. You see the form number, and right here, it's basically the same. It shows the history of the account, but instead, the code number explanation says trust fund recovery penalty. Again, you can kind of stop your analysis right there and say, hey, that $2,500 is not going to be dischargeable when you get out of bankruptcy. You might want to go see a tax attorney and deal with that. So it sets them up for success, because I think a lot of clients get out of bankruptcy and they're frustrated when they have $50,000 or any amount due after bankruptcy and they're not really sure why. Oh, another helpful tip, we're talking about Georgia Statement of Account. Those can also be requested by your client or through a power of attorney form. Georgia has this really great tax center online. I have a power of attorney form for a client. I normally set up their account myself. And it will have the account balance. It will have all transactions that when they receive returns. You can request statement of account. So unfortunately, Georgia doesn't have the same level of detail that the IRS does. So you can still do this step and get the statement of account. And it will at least show you the periods and the amount due. And so an example is here on the right. You'll see what tax periods are. This one's pretty easy, right? 14 and 15. You know that it doesn't meet the 3-year rule, so you can look at that and say that's not going to be dischargeable. Right? Or if you're filing 13, that's going to be a priority claim, and they're going to have post-petition interest. So you can already have that conversation with your client. Another option is you can fax the power of attorney form to Georgia Department of Revenue. Again, it normally takes 8 to 10 business days, and then you can call that number, which may take an hour or two to request a statement of account. I prefer option 1. It's power of attorney form. You can file it with the Georgia Tax Center and then just pull the records online without calling. But if you're in a hurry, obviously call the number, and they can fax that or email that information to you right away. Okay, this is my last slide of my presentation. Should you wait to file? So a lot of times I ask my clients, what are your goals, right? Like if they have a foreclosure but they don't want to keep their house, then is that really an issue? I don't know. If they have $50,000 of tax debt that may be discharged if we wait a couple months, it depends on what their goals are. If they have a repossession or foreclosure or wage garnishment and those things are at the top of their list, then it might not be a good idea to wait. But if they don't have anything that's forcing them into filing bankruptcy, you really should be taking the time. You should be taking the time to do this analysis anyways. But those are questions you should ask, right? And go over if we file now, you should be able to tell them, if we file now, you're going to discharge $25,000. If we wait 6 months, you're going to discharge $75,000. And that can really impact how a client feels about a bankruptcy case, especially when they get out. That information should be provided to them before they file. It really should. Not to scare anyone, but we've had 2 clients that have sued bankruptcy attorneys and malpractice claims because the bankruptcy attorney filed the bankruptcy case 8 days too early and could have discharged $100,000. It's really not that hard. It does take more time. I think you may have an excuse if there was something imminent, right? Like they had a foreclosure and their house was going to be foreclosed on tomorrow. That may get you out of it. I'm not trying to scare anyone, but it really is part of your job. It's a type of tax. It's a type of debt. You should know how it works and when it's discharged and when it's not. We know about mortgages. We know about everything else. So one more thing to learn. And then lastly, just to talk about this, will the filing toll collection statute expiration date? That's called a CSET. So the IRS has 10 years to collect the tax from the date of assessment to the date, so add 10 years. Now, certain activities that a client can do, like filing an offer in compromise, that will add the time that they're in an offer plus 30 days, or a collection due process, the time in a pending installment agreement, or judgment litigation, the time that they're in bankruptcy. That can all add time to the CSET. So an example is, I have a client, in 4 days, this tax will completely expire. The collection statute expiration date will be up. So if I wait 4 days to file bankruptcy, that tax is going to disappear. It will evaporate in the thin air. If I file the case today, well, that puts a freeze on the statute. So I got 4 days plus the time in bankruptcy plus 6 months. So if that's a Chapter 13, oh, gosh, now I just added 4 days, 5 years, and 6 months. So when a client gets out, and if it's not a dischargeable one, I just really added some time there. So I always try to take that into consideration. Think about, is this going to toll a collection statute expiration date? If you're not comfortable doing this analysis, you can hire a tax law firm. They'll do one for you. Or you can always call the IRS and ask for a CSET. They have very sophisticated computer programs that factor all the tolling in. And if you have that power of attorney form, it's really easy to call when you're getting balances. Hey, can you tell me what the CSET is? And by gosh, by golly, they will give it to you down to the day. So that's really easy if you don't feel like doing that analysis. It's a lot of math. Or you don't know all the exceptions. You can ask for that information and they'll provide it to you.
So when you're saying ask the IRS for this information, are you talking about calling an insolvency specialist? Are you talking about calling the 1-800 number? What's the best way to get this information? Because I'm sure you can imagine.
There's a lot of numbers.
There's a lot of numbers, and there's the major complaint is
it takes a long time.
We don't want to sit on hold for 3 hours.
Right. So the great thing about the number I provided all of you guys is the TPA Priority Practitioner Hotline. That is solely for people that are attorneys, tax preparers, enrolled agents. So only, general taxpayers can't call that number. You have to be a certain level to call that number. So when you call that number, the wait times there can be 20 minutes, maybe. If you try to just call collections, that could be a 2 or 3 hour process. Every day I walk in my office, I just dial Georgia or there. I dial one of them, and I don't even know what client I'm calling. I just call because I got to talk to them about something. So I would recommend calling PPH because they will direct you if they're in collect. Like I said, stovepipe, right? They all have their own little unit. If you call PPH and they say, well, your client's in collections, we can't help you with that because we only do one thing. You say, cool, can you transfer me to collections? And they'll snapshot you right over to collections, and it won't take as long as if you would just call collections. So always call PPH, and they'll get you where you need to go a lot quicker than if you just try to call whatever unit you're trying to talk to.
All right. So we'll switch gears a little bit. And in a majority, this is Whitney, by the way, in a majority of the bankruptcy cases that I handle, my client is typically the Georgia Department of Revenue rather than other state agencies, but some of my other Georgia clients in bankruptcy are the Georgia Department of Labor, the Georgia Department of Community Health, and the Georgia Lottery. But this slide is kind of interesting. I think it's the 2015 active bankruptcy cases that the Georgia Department of Revenue handled. So you'll see the bottom right, grand total, that's about 20,000 active bankruptcy cases that they are handling. You'll also see that a majority of those are Chapter 13, about 15,000, and then Chapter 7 no assets come in, and then some Chapter 11s. And these are broken down by type of corporation or if it's an individual and that type of thing. So I just thought that would be kind of an interesting slide to give you perspective in relation to how many bankruptcy cases your firm handles or you personally handle. So the next slide we'll talk about tax-related exceptions to the automatic stay, and those are found in 362B9. So these are actions that don't necessitate filing a motion for relief or exceptions to the automatic stay. So those would be tax audits, notice of tax deficiency, demand for tax returns, tax assessment and issuance of a notice and demand for payment, and in 362B26, pre-petition income tax refund offset against pre-petition income tax liability. I find myself referring to that and referring that to answer questions frequently. So as far as the Georgia Department of Revenue goes, proofs of claim, they really try to get their claims filed within 90 days of the filing of the petition. But they are very helpful and super responsive, I have found. And so to the extent that there's a claim that's been filed and you've got questions, don't hesitate to reach out to them. This slide has an email address, and they work this. So feel free to use this email address or the phone number, which is given on a later slide.
And I'll say the IRS counterpart to that, I think most of you know, the proof of claim has the insolvency specialist who has prepared the proof of claim. It should have their phone number and email address. In most instances, the specialists are very helpful, and they will get back to you. They're supposed to do it within a certain amount of time. Sometimes it takes a little bit longer than that, but they will get back to you and try their best to answer questions that you have about the proof of claim. More often than not, if there are questions about the proof of claim that they cannot answer, they will encourage you to call me directly, and we'll see if we can't go through it line by line and figure out what the issue is.
And so most of you probably know the Georgia Department of Revenue does not file a proof of claim for tax periods that aren't filed. If there's other tax liability that does exist, they'll file a claim for that, and they'll note at the bottom most of the time that there's no claim or no return that's been filed. And so that's really helpful information. And they don't typically file proofs of claim for minimal amounts. I don't have a threshold amount to give you because I think that changes periodically. And obviously, the debtor's counsel, you can file a proof of claim for the department if they haven't filed a claim. The next slide is Georgia Department of Revenue's contact information. So to the extent that you're filing a claim or you just need to get in touch with them, but if you're filing a claim, this is a good address to use for the claim. If you need to send them correspondence. And again, this bankruptcy notice's email address and the phone number.
Oh, I was also going to mention that department is also really helpful If you're in a bind and you say, I'm about to file bankruptcy for a client, can you please get me a statement of account before we file? This department is really great. They answer pretty quickly and can give you that information a little bit quicker than the general way, but I typically try not to bother them unless I'm just in a hurry with the bankruptcy filing.
The next slide is about the Georgia statutory interest rate, which has changed. It changed last year, and it was effective July 1st of 2016. But when you're writing your plan and you're treating the secured portion of that tax debt, and you would typically give them 12% interest, that has changed, and it's similar to the TIL interest rate, which is prime plus 3%. So for 2017, the interest rate is 6.75%. So I'm sure most of you already know that, but to the extent that you don't, you can take advantage of that. Now we'll get into a little bit of the code and what taxes are and are not dischargeable. Alyssa alluded to a lot of these before, but these are just the code sections that you would look to the extent that you're needing to track that down. So 1328A2 is after completion by the debtor of all payments under the plan, the court shall grant the debtor discharge of all debts provided for in the plan except for any debts of a kind specified in 507A8C and 523A1B and 523A1C. So 507A8C, that's a tax required to be collected or withheld, so that's like a sales tax. 523A1B, a tax where a return was not filed, that's not dischargeable, or a tax filed within 2 years before the filing. So that's the 2-year rule that you most frequently hear. So under the 2-year rule, your income tax returns must have been filed at least 2 years before you file your bankruptcy petition to get it to be discharged. If it's filed within the 2 years of filing, it's not dischargeable. And that would be the code section that you'd look to find that 2-year rule. 523A1C is where the debtors made a fraudulent tax return. That's not dischargeable. And where their debtors made a willful attempt to evade a tax, that's non-dischargeable.
So we kind of talked about this in our little meeting that we had. I haven't had a case with Vania yet, but it's a conversation I have with a lot of my tax clients when they waltz in and say, I want to file a Chapter 7 because I don't have to take the means test. Someone told me I don't have to take the means test because all my tax debt is non-consumer debt, so I have to take the means test, and all my tax debt is going to be dischargeable. And sometimes I have to bring them down because they're looking at trying to discharge $1 million. And I have to say, you know, they're probably not going to let you get away with that. Because although your tax maybe meets all these tests, right, we meet the type of tax, we meet the 2-year rule, we meet the 3-year rule, we meet the 240 days of assessment rule. There's only really 5 rules. The fraud and willful evasion rule still stands there, even if you make all the time, requirements. And where that comes up is where we have a client maybe that is doing something called pyramiding. They owe tax in 2008. They owe tax in 2009. They owe tax in 2010. And it just always continues to go up. They know they owe tax. They're not adjusting the withholding. Typically, that's not the kind of client we're dealing with. We're normally dealing with like a 1099, some kind of corporation, a client that has a business, right, that gets a K-1, not paying estimated tax payments. And it keeps going up and up and up and up and up. It's called pyramiding. The IRS really frowns upon pyramiding. They're willing to forgive you sometimes, but after it gets to be a habit, they're not willing to forgive you. So willful evasion comes in. Again, I talked about the standard with trust fund recovery. These standards are pretty low. So willful evasion really requires 2 things. Did you know you owed the tax at the time? And the second thing is, what did you do with the money instead of paying the taxes? I've been to at least 5 of these hearings, especially when I interned for Judge Murphy. I remember watching them, and just it's one of the craziest things I've ever seen. So the first thing they'll do, they'll put the client on the stand and say, did you know you owed taxes in 2009? Client says, yes, I did. And obviously they know they did because they got 100 letters from the IRS saying that they did. That one's kind of hard to combat, obviously, because the IRS is so on it with letters. They send them every couple of months, every year. And then the second is, what did they do with the tax? They'll take your client's bank statements and they'll look through and say, I was saying in 2009 you owed the tax. Yes. So and in 2009 you paid for Sally to go to Ole Miss. Yes. Bam. Willful evasion. Hearing over. It's not really hard when your client takes money that they could have paid their tax debt with and pays other things. It's not just sending a kid to school, it's sending a kid to private school, buying a car. Sometimes it doesn't really matter what they spend the money on. It's the fact that they knew they had the taxes and they chose to spend their money otherwise. And that's enough to get willful evasion and not have a tax discharge. I've had at least 3 people that have come to me after a bankruptcy case where they got willful evasion orders on adversary proceedings, and the tax debt is non-dischargeable. And then what the IRS or the service has been doing lately is they take that and turn it into a district court judgment. So they'll file a district court action and turn that into a civil judgment for the government, which now that 10-year CSED that I talked about is now a 20-year judgment. So it's going to be there for a very long time. So another thing to consider when you have I call them a holy roller, high roller, and they think they're just going to walk out of a Chapter 7. I don't know what the threshold is, and Dania obviously can't tell me what the threshold is, but if you see a history and you see the dollar amount is pretty high, I would say $100,000, there's a chance that that could be a part of their bankruptcy case.
And I'll note, just from what I see, when we're talking about an adversary proceeding that's filed and debtor loses, or they're trying to discharge the taxes, they lose because of this willful evasion. When you file the adversary proceeding as debtor's counsel, if you see that DOJ tax swoops in as opposed to little old me, I would just say to be on notice that there may be some additional issues that you need to possibly ask your client some more questions about.
So Chapter 7 discharge, we all know the discharge code section 727. And an individual is the only, a business can't get a Chapter 7 discharge, only an individual. But Section B has the exceptions. The debtor gets a discharge of all debt except as provided in 523. And we did talk about 523 on the previous slide, 523A1B, where the return isn't filed or filed within the 2 years of filing, or 523A1C, which is the fraudulent or willful attempt to evade a tax. But 523 also references 507A8, and A8 has all sorts of taxes in there. We talked about on the previous slide 507A8C, which is that withholding taxes that are withheld, so like sales taxes. But 507 also, there's A8, big A, little I, and 2 little I, and those within those parts are the 3-year rule and the 240-day rule. So the 3-year rule, this rule states that, as a general rule, to discharge your back income taxes, they must become due at least 3 years before you file for bankruptcy, or if they're due within the 3 years of filing, then that's not dischargeable. And then you've got the 240-day rule, and to discharge taxes, taxes must have been assessed by the taxing agency at least 240 days before you file for bankruptcy under this rule, or not assessed at all. So if the tax was assessed or not assessed within the 240 days, then that's a non-dischargeable tax debt. 507 also, other parts, A8B, property taxes, not dischargeable. A8C, we talked about that, withholding sales taxes. A8D talks about employment taxes, not dischargeable, and A8E, excise taxes. Then the next couple slides are just kind of a summary of what I just talked about, the exceptions to discharge. We'll land on a slide that talks about the Jones case. So this is a case that I frequently share with opposing counsel, and it talks about a state tax becomes non-dischargeable under 523A1B little I when the taxpayer or debtor fails to file an amended state tax return. And that triggers OCGA 487-82E1, which requires the taxpayer or debtor to file an amended state tax return when the IRS reassesses or audits the taxpayer and the debtor's income is adjusted upward. When that happens, when the IRS does that adjustment, that triggers this code section and the burden on the debtor to file an amended return. And if that isn't filed, then that tax debt becomes non-dischargeable in the bankruptcy case. The next, that's just the OCGA. If you just want to read it. That's the code, the Georgia code that talks about what I just talked about. Sorry. Okay, let me go.
I'm just going to discuss very briefly this 11th Circuit opinion that came out in March of 2016. It's called, we just refer to it lovingly as the Justice decision, but it's In Re Justice. It was originally the Middle District of Florida. And in Justice, a Chapter 7 debtor sought a determination that the Form 1040s that he filed well after the deadline for filing the returns and after the IRS had issued its notices of deficiency, that those returns, that those 1040s constituted returns under the Bankruptcy Code. I mean, the issue is just that. If your client has a substitute for return that's filed by the IRS, and then they go back and they file their 1040s, can the taxes for that particular period be dischargeable? Are the returns that they filed actually returns? Section 523 of the Code defines what a return is under the Bankruptcy Code. The slide will tell you the Code defines a return as a return that satisfies the requirements of applicable non-bankruptcy law. Well, what's that? To determine a return under applicable non-bankruptcy law, the IRS looks to this case called Beard versus Commissioner of Internal Revenue. From this case, there were 4 factors that came from this case. The factors are that a 1040 to be a return has to purport to be a return, it has to be executed under penalty of perjury, it has to contain sufficient data to allow calculation of the tax, and it has to represent an honest and reasonable attempt to satisfy the requirements of the tax law. In going through Mr. Justice's case, he filed his bankruptcy in 2011, and he had taxes that he was trying to discharge from, I believe it was tax year 2000 to 2003. He filed his returns after the IRS had filed their substitute for returns. And there was some abatement of the taxes that the IRS said he owed, but there were still these substitute for returns. The court, in going through the Beard factors, determined that the only prong at issue was prong number 4. There were some other circuits that had decided the issue, and they decided it on a matter of timing, whether if you file your return 1 day late, does that mean it's not a return? The 11th Circuit said that they weren't going to look to that to determine whether or not it was an actual return. They were going to look to the 4th prong. Did the debtor, by filing late, evince an honest and reasonable effort to satisfy the requirements of the tax law? And the circuit said no. When you file late after the substitute for return has been filed, you're not evincing an honest and reasonable effort to satisfy the requirements without some justification. I think, and this is just Tania, that the circuit has left a little bit of wiggle room, right? It's really factually determinative without any justification at all. Well, what could be some justification for filing a return late? I won't give you any examples because I don't have any, but when you're going over this issue with your client, maybe look and see if something really extreme happened that prevented them from filing timely. That's just...
I would say some kind of mental or physical incapacity. The IRS has some relief programs where it kind of function around inability, like impairment. I think that might be a good example. I've never had a client that I was like, oh, you might win this one. Or that they give me a lot of reasons, but I've never had one that I think would come into that category.
And I haven't either, but I'd like to see one. I mean, I think it would be an interesting case to try, and I imagine they would maybe let me hit third chair. But DOJ Tax really likes to litigate these kind of issues, and I think they're interesting. So if you have one, please file. We'd love to get into the weeds of this.
We'll talk about a couple cases here, just tax cases, kind of short and sweet, but easy. Post-petition taxes, this is the Hester case. The Chapter 13 discharge generally has no impact on post-petition claims. Those would survive the discharge, and same would be for a Chapter 7, good general rule. The next slide, post-Chapter 7 discharge, so after a Chapter 7 discharge, we'll look to the McCorkle case. So 524 only stops or enjoins actions to collect on the personal liability of the debtor, but does not enjoin actions to renew or continue a lien. So the state can re-record its tax lien or its tax execution without violating the discharge injunction. The next slide, we referenced the Smith and the King cases that talk about state and federal tax liens are not avoidable under 522F. Sometimes I get motions to avoid liens under 522F, and state and federal tax liens are statutory liens and not judicial liens, so they're not avoidable under 522F. The Carolina Resort Motels case, tax liens are not voidable. State and federal tax liens are not voidable. Preferences under 547. A tax lien is a statutory lien that the trustee cannot avoid as a preference, as the filing of the notice or recordation of the tax lien precludes the finding of a preference. If you find yourself in a Chapter 7 or talking about preferences, you could look to this case. And then finally, I guess that was it. That was it. So, thank you.
Thank you all so much for coming. As we said, now is the chance for you to cover our panelists with those burning questions that you have. How about Ben? I saw your hand.
As of the tax liens, federal and state are not avoidable under 522 if they're not a judicial lien. But what if they turn it into a thing? Is that judgment then becomes avoidable?
That's a good question. I think all of these are very fact specific. So I would say certainly if that's something that you want to file, I mean, I'm sure there are some ways that you could avoid some liens. So, you know, that might be something that you, but under 522F, you wouldn't be able to do it.
Not a practice. I only got the never been rating by client.
So I think your question is twofold. As to your first question, whether you should look to the proof of claim to advise your client, I think Alyssa said it best. What you need to do is get a transcript. I would start there before even looking at the proof of claim, because then
They can be wrong sometimes.
I mean, it's prepared by a human, so there could be errors. Start with the transcript, and then you don't necessarily have, and you look to the proof of claim, but if you have that as a starting point, then you can answer some of your own questions. If you're asking whether the service might amend a proof of claim when a case converts from a 13 to a 7, the answer is yes, if they feel they need to. I mean, if it converts from a 13 to a 7, and the 7 is an asset case for some reason, for facts that we're not discussing here, then absolutely they'll amend their proof of claim.
So, for example, if you go to research and
I would, if those are my facts, I would call the insolvency specialist and get a bit more clarification, who will then probably tell you to call me.
But I have seen where it lists unsecured, and then it will say that the tax is in this, like they've had it in the wrong category, but it's like, well, the fact that no return is filed makes it non-dischargeable, so it would be preferred. Like, but it's in the wrong section.
It's in the wrong section.
I've seen that more than once.
It happens. Correct. I don't know if trustees would allow that, because that technically you're giving preference, right? You're giving post-petition, you're allowing a post-petition claim to be paid ahead of unsecured creditors, right? And we're supposed to be treating everyone equally within their class, and we're only treating pre-petition claims. So I think that could be an issue. And when I explain to my clients why they have post-petition interest, I explain because, right, that services are going to calculate the interest that's going to be due accrued over the next 5 years. Like we don't, because that would be adding in a post-petition debt. So maybe it's more helpful to our clients. But oftentimes as a tax attorney, when they get out of Chapter 13, I have one right now that's got an $80,000 non-dischargeable claim. I'm not planning on her paying that back. I'm going to put her on some kind of IRS relief where she doesn't have to pay it back. But there's a lot of great IRS programs for relief. So if your client qualified for bankruptcy, they probably qualify for one of these relief options where they wouldn't have to pay it back anyway.
And I think it's just important to tell your client on the front end that they will more likely than not get this letter of notice of deficiency. I mean, I've received all kind of threatening letters. We're going to sue you. Okay, that's fine, right? But it's not going to have your client's still going to owe this interest.
Yeah, another question?
Is there any way to calculate that interest? Maybe you can come up with some kind of cushion to prepare your clients for that when they come out of the 5-year term?
Well, sure. The question is whether there's any way to calculate what this interest is, what the interest will be, the post-petition interest or the interest that continues to accrue on these non-dischargeable taxes while the client's in bankruptcy. At the end, you can get what's called, like I mentioned, it's called an INST report. I think probably the best way to get that, because if your client's no longer in bankruptcy, the insolvency specialist not going to talk to you. They're not allowed. The number that Alyssa mentioned with the PPH number is probably the best route to go. Otherwise, you're going to end up having to call the 1-800 number. And as many of you know, that means you're going to be on the line for a while. But you can receive an INST report, and that'll give you the amount.
It kind of does set them up for failure, though, because in Chapter 13, we don't allow for savings, right? So, like, when something happens to them, they don't have any disposable income, right? So I don't know how they would even create a cushion. I think it kind of sets people up for failure. Yeah.
Have it in their mind.
To know.
When they're going to come out of the chapter. You can tell them all day long, but they never hear you.
Right.
All right. Well, how about with that, let's thank our wonderful panelists, and you could please also fill out your surveys with yellow sheets on your tables and drop them off with a scale or on the table as you leave. Feel free to, if you have any last lingering questions, and thank you all for coming today.